Let's talk about something that most traders overlook, but is critical for understanding what's really happening under the surface of the market. Imbalance. Picture this: two sides of a tug-of-war game. One team has 10 players pulling it hardest, while the other team has just 2 players giving it everything they've got. You don't need a crystal ball to predict the outcome. It's clear that the team with the numbers and the force will win. In trading, the market operates on a similar principle. Buy and sell orders interact in a constant tug-of-war. Imbalance occurs when one side of this struggle clearly dominates the other. And guess what? By identifying these moments, you can trade on the side of the stronger team, the side that's about to drive the market in their favor. Imbalance is a key concept in volume analysis. It refers to a disproportionate number of buy or sell orders at a given price level. Essentially, it's when buyers or sellers overwhelm the other side so decisively that it leaves a visible footprint in the market. Think of it as the battle scars left on the order book. And just like a seasoned warrior studies the scars on their shield, we study imbalances to uncover hidden truths about who's winning the fight. Now, let's break it down. When you look at an order flow chart, specifically the footprint or cluster charts, you'll notice numbers showing the volume of trades executed at different prices. This is where the magic happens. A buy imbalance occurs when there are significantly more aggressive buyers than sellers at a price level. A sell imbalance is the opposite. Aggressive sellers overwhelm buyers. For example, if buyers aggressively hit the ask price with 500 lots while sellers only manage 100 lots, that's a buy imbalance. Now, why does this matter? Because these imbalances reveal the market's superior forces. They show where liquidity is being consumed and where it's about to drive price action. Here's where things get interesting. Imbalances aren't random. They're the footprints of smart money and large players positioning themselves. Wyckoff and VSA teach us to look for signs of strength or signs of weakness. Imbalances often occur during these moments. Stacked buy imbalances appear in markup phases, signaling demand outstripping supply. And stacked sell imbalances show up in markdowns, where supply overwhelms demand. These clusters of imbalances act as validation points, telling us we're on the right side of the trend. This is why imbalance works so well with the metrics we've covered so far. In two-way absorption, imbalances can signal the point where one side finally breaks. With Trend Pulse, we observe how imbalances align with the VWAP deviation bands, showing when trends gather momentum. And with liquidity drivers, imbalances give us a glimpse of the force behind liquidity takers and givers. When combined, these metrics give us a complete view of market dynamics. So how do we use imbalances in real trading? The key is to focus on areas of interest, value areas, accumulation or distribution zones, and wait for imbalances to confirm the next move. For example, during a range, imbalances near the highs or lows can signal a breakout. In a developing trend, stacked imbalances confirm momentum and allow you to ride the wave with confidence. This also helps us avoid the trap of preempting moves. Instead of guessing, we're reacting to real-time evidence of strength or weakness. Finally, this brings us to the last metric: exhaustion. While imbalances show the winning team, exhaustion signals when the winners might be running out of steam. It's the final puzzle piece in understanding how trends evolve and reverse, tying back to everything we've discussed so far.